Hi, I'm Mike Caldwell. I'm the Director of the Business Innovation Zone. The Business Innovation Zone, or the BIZ, was created to help high-growth potential entrepreneurs and businesses in central Iowa. We provide a variety of services, including mentoring, consulting, counseling, validating business models, and help with access to funding for high-growth companies. We offer also a number of networking opportunities, including luncheons once a month and all-day seminars on subjects such as marketing and finance. You can find out more about the BIZ at www.bizci.org.
Valuation is an interesting discussion, and as you start off thinking about it, if you look at the publicly markets, like a stockbroker, if you wanted to buy a stock in Coca-Cola or Exxon or somebody like that, there's a lot of smart people trying to determine what that's worth. They spend a lot of time, and the assumption is there's an efficient market, so you go to your stockbroker, you go online and buy a share of Coca-Cola or Exxon, and you're getting what the fair market value is of the stock at that day. The systems are working, the network's working, the valuations are set. But the thing to remember is valuations change over time. There's various things that can change a valuation. So if you say you buy a share of Exxon and it's at a certain price, and then they have the big oil spill. Obviously, bad news. Nobody saw that coming. The stock price is going to tank. So there's outside factors. The financial crisis, the stock market went down. Nobody could really control that. That affects valuation. So that's one thing to remember. There's things that are beyond the control of the company, external factors that are going to affect your valuation once you get it set. The other factor is the company continues to make money. They exceed what expectations. So in the public markets, the company says, hey, I think we're going to make $1 million this year, and they make $2 million. They exceeded the market's expectations. The fair market value of the company was based upon the $1 million, the $2 million, so the stock price is going to go up. So there's things that are in the control of the company that they're going to affect valuations. So as we get into talking about that, obviously your companies are private. There's not a lot of smart people spending their day determining what the fair market value of your company is. But the same process is the same thoughts that go into the public markets are the same processes that are used to determine what your valuations are. So the key, when we're looking at, and again, we're talking about equity. So when you sell an ownership in your company, the key is you've determined I need to raise capital, I need equity. What do I sell it at? You can't go to a stockbroker, they have no idea what it's worth, so you need to come up with what the fair market value is. And really the fair market value is what somebody's willing to, what somebody's willing to give you for it and what you're willing to sell it for. So it's an arm's length transaction. But there's different things that we'll talk about that will help you determine what that fair market value is. When you look at your company, there's different buzzwords, there's different things out there, and the fair market value is what it's worth, but then there's an equity value and an enterprise value. So the thing to remember here is when you buy, it's like, for example, you buy a house, and the house is worth $250,000. That's the enterprise value of the house. But if you have a $100,000 mortgage, the equity value of your house is going to be the $250,000 less the $100,000 or $150,000. Same with your company. We're going to go in and determine what the value of your company is, and then that's the enterprise value. If we have any debt, we back the debt off, and that gets to the equity value. So that's what's left after you pay the debt that's available to the stockholders. That's the equity value of the business. So when we talk about it, the public markets are easy. You go to a stockbroker, you figure it out. You're at a point now where you want to go, friends and family. You want to go to an angel investor. You want to go to a VC firm. And you want to sell equity. What do you sell it at? So you need to kind of figure out, what the fair market value is, what my equity value is, and how do you go about doing it. There's various points to consider, and the common valuation approach. One approach is the asset approach, and again, this isn't used very often. Maybe in a turnaround situation or a highly capitalized company with fixed assets and those types of things, you'll look at the assets of the company and say the fair market value of those assets is a certain amount. That's the value of the company. But again, that's more for a very asset-intensive type company. But that's one approach that you would use to figure it out. But usually there's not much weight placed on that. Probably the most driving valuation method that people use is the income approach. And under this method, what you do is you take your business, this is how much income we're making, this is how much cash we're making, and you say, okay, over the next 3 to 5 years, we're gonna do this. So it's projection based. And what you do is you take the value of those cash flows, the future cash flows, future incomes that are coming, you discount it back to today's dollars, and you come up with what the value is worth. So again, you're controlling what the value of the company is worth at that point in time, and it's based upon what you think you can do with the business. The other approach that you would use then is the market approach, and as your company gets bigger and more established, what you would do is say you're going to know who your competitors are in the marketplace, and these competitors may sell, these competitors may raise money, these competitors may do a lot of different things, and you can use those transactions that your peer group's gone through and say, hey, XYZ company sold for $10 million. You know, I'm only a couple years behind them. I can use this as a comparable to say my company's worth X% of $10 million because I'm getting close, or 2 times $10 million if you're farther along. But that's the next approach to use is what somebody else was willing to buy a similar type of company for in the marketplace, and make it work. You know, we talked about web filings this morning and the work that we did on that company. You know, one of the multiples that when Google's buying companies, which is a big company, but web filings is similar. You know, as a similar business, it's 1 million times the number of developers that are out there. So there's some unique types of multiples that can be used for various types of companies depending upon what industry you're in. But the common ones are multiple of revenues. So if you're not making money but you have revenues, you could use a multiple of revenues. You could use multiple of earnings. The workforce. If you have a unique workforce and you put it together, there's value in your workforce. There's a number of different things that can be used. So what you do then is you get in and you're preparing to go out, talk to people about raising equity. So you go through those different approaches, and you kind of say, okay, I did this, the asset approach, I came up with this amount. Income approach, I came up with this amount. The market approaches, I came up with this amount, and you kind of say, well, the income approach makes the most sense, so I give most weighting to that, and the market approach makes some sense, so I give a little bit of weighting to that. The asset approach probably doesn't make much sense, so I'm not going to give any weighting to that. And you come up with what your value is worth. And and then what you do is you take that, and there's maybe some other adjustments you make to it. Maybe you're going to sell a minority interest rather than the whole thing, so you discount it a little bit. Maybe there's negative working capital and you need more working capital, so you adjust it for that. So there's a lot of different calculations that go into it, but the main thing is just to understand that the approaches that are used there and the controls that you have in place. So the controls is what you do with your business, how you can grow your business, and how much profits you can make out of it. That's what you can control. Some of the things you can't control is, it was the late 90s and if you went out to raise money, market's hot. You can have the same business and the valuation is probably going to be 100 times higher back then than it is now. Same company, same business, but it's just doing to the market. The financial crisis recently, I think, really hurt companies. The valuations went down, and it really nothing to do with the business, but it just was the way the external factors are. So those are some other things to take a look at. So the key is that you come up with what your value is, and what do you have after that? You have a nice valuation. You go to somebody like Adam or whoever, and you say, hey, company's worth $15 million, write me a check. Well, it doesn't quite work that way. It's the key is, and what I guess the approach that we'd like to see with our clients is you come up with a methodology and you look at the investor population that's out there, and you maybe find ones that like your industry, like what you've done, can add value, and you go start talking to them with your valuation approach. And what you try to do is find the lead investor, somebody that likes what you're doing, and you negotiate your valuation with them. So there's that arm's length transaction stuff that's going on that we talked about. So you have some rationale for what you think your company's worth. You go out and deal with somebody that's really going to write a check, and you try to figure out, with somebody who may be your ideal investor, what they're willing to write the check for. And maybe you talk to 2 or 3 different people and see if you can get somebody to commit a significant portion of the capital you're trying to raise at the valuation. If you can, then you have some credibility. You have, hey, You know, if you're trying to raise $1 million and somebody's willing to write a $250,000 check or whatever, you know, I got XYZ companies investing at these terms, and you go out and start talking to people, and that seems to work the best. It kind of snowballs and goes from there. So that's, I guess that's kind of an overview of the valuation and the approach to go out to get equity. Any questions on that? Any ads, any comments anybody has? Again, it's a subjective approach, and the key is to try to get, you know, as much going on as you can, and a number of different options as going on as you can to try to get, you're just not just relying on one person, you're getting several people to you know, kind of like when you're selling a house, you try to get a couple different people, or selling a, you know, a couple different people to bid on it, that you maximize the price that way. But when you get, so now you're going to start talking to people about the valuation of who could invest, and then what they're going to do is take a look at the work you've done on your valuation, and they're going to pick apart your business to see, you know, the due diligence or whatever, to see, you know, if there really is substance there, if there's any weaknesses, or are there any things out there that I should be concerned with that would affect the valuation that you propose, or even affect the decision whether to invest or not at any valuation. But you know, we've kind of listed out 7, 8 different types of criteria to really take a look at as you're preparing your valuation and you're preparing your company to go out to raise equity. And first is the business concept that I have, is it understandable and is it sustainable? You know, one of the, you know, we worked with a company back in 1999 that they bet the world on Y2K being a huge problem. Okay, potentially it was sustainable. Y2K wasn't a big problem. Obviously, the business didn't make it, and it didn't work out. So, post that event happening, there was no sustainable business model. So that's the main thing to take a look at: is my business sustainable over time? Does it work? Does it make money? Are people willing to buy my products and services? The next one is what makes me unique. You know, am I a commodity out there? Are a lot of people doing what I'm doing, or do I have something? Do I have a patent? Do I have am I far enough along that I'm a year or so ahead of everybody else for what's going on in my development? You know, what makes you unique in the marketplace to support your valuation? Probably the biggest one is outside validation. We talked a little bit about this morning. You know, do I have customers that are paying me for my services, and for what they're paying me, can I make money doing it? If I don't have customers, do I have testimonials saying that, yeah, if you build this, they'll buy it? Strategic partners are a big one. You know, we talked about funding your business with a customer. There's a lot of value in saying, hey, a customer is willing to pay me up front for developing my product. It goes a long way. And then outside professional assessment. If you're just getting started, I think you talked about the economic analysis form. I think that you know, a lot of times if you have an expert saying, hey, this is a great idea, that helps in the early stages to raise money. Another important thing as you go out to get equity is a very important thing, is the management team. You know, the investors that come in are going to look and say, okay, you're the founder, you're the guy behind this. Can you do everything, or do you have the right support around you? Do you have the right salesperson? Do you have the right technology person? Do you have, you know, the right operations person? Is the team here to make this business work, to let you know, achieve your objectives? And a lot of times this is especially as you start out, a problem to overcome. And that's where I think people talk about advisory boards. They talk about, you know, bringing the right investor in that wants to get involved with the company and help grow it. There's a number of different ways you can get around this, but betting on the jockey is an important thing for your company to maximize your valuation and to get any type of funding. Predictable business model. You know, this one, you know, you see a lot of times back in the old days, software used to be licensed in big license fees, and so one quarter you may have, you know, you sold a couple big license fees, and the next quarter you don't sell anything, so your revenues and profits go like this. You know, it's not predictable. You can't predict what's going on. But if you have a recurring revenue model, a lot of people like that nowadays. Recurring revenue model that kind of ticks along, obviously predictable. And is there an exit strategy? You know, equity is permanent capital, but a lot of times, most of the time, these investors don't want to be permanently involved with the company, so they want to get out somehow. So you can do it through a buy-sell agreement, or you can say, hey, within 3 years to 5 years, I'm going to sell, or You know, back in the good old days, we say, hey, we're going to try to go public, you know, and you have your stock be registered. But you need to have a plan in place to be able to get these equity investors out. No, so the important things of valuation, I think, is it changes over time, and sometimes it changes without anything you're doing, anything with, you know, you don't have control over. But the key is to have those 7 criteria teed up within your company and be able to demonstrate that you can achieve your projections. And if you do that, you'll be able to maximize the value of your company. And when you bring in equity, give out, you know, as you as business owners want to give out as little as ownership as possible when you bring in the capital. You know, that's a good point. It's really an art that you really need to be able to, and Christian's going to give you the pitch, but I think that's part of it is why you're supporting your valuation, why this number makes sense, and why you're unique, you know, why you can make it work. That initial give up of capital is expensive. You know, it's easy to say, okay, you get 5%, you get 5%, whatever. That's expensive money that you're giving up. So you better make sure that those people you're giving the stock to, it's not just a friendly gesture, that you're going to get the value out of it.